Hello and welcome to a CMS Forex Daily Video Recap. I'm your Fundamental Market Analyst, Nick Nassar. Today is Thursday, July 1st, 2010. First, let's begin with the Euro-Dollar pair, where we saw a very strong move in favor of the Euro, with the highest gain from low to high that we've seen in this pair in several months. First of all, overnight, we had a pretty successful auction for Spanish government bonds that started the gains in the European session for the euro, and they only picked up in New York trading as we had some weak U.S. labor market and manufacturing as well as housing data all coming in below forecasts, which gave there some very broad dollar weakness during today's session. We'll take a look at the moves against the dollar against its other rivals in 1 second. The Spain Treasury sold the maximum intended 3.5 billion euros of 5-year government bonds in today's auction, which came one day after Moody's had said that they had warned Spain of a possible downgrade to its AAA rating. In the short run, the auction alleviates fears that the combination of rating downgrades, undercapitalized lenders, and thinning capital market liquidity could snowball into another sovereign liquidity crisis in the Eurozone. In a second important development, the ECB lent banks close to 111 billion euros in 6-day loans in order to help them cope with the expiry of its 12-month loans given out 1 year ago in an attempt to buttress the European financial system following the financial crisis. Banks needed to repay 442 billion euros in 12-month loans, the biggest amount ever awarded by the ECB, and had asked for 122 billion euros in 3 months loans yesterday, which was less than expected. In addition to the 6-day loans that were given out today, in order to raise the money, banks may have had to cash out in profitable positions, such as gold. Looking at the gold chart, we see a huge move downward, perhaps as banks had to scramble to meet those obligations to the ECB. Another look at it could be with fears of a global double dip increasing. The safe bet right now is U.S. Treasuries, but gold has been used as a safe haven play during the European sovereign debt situation, so it seems kind of unlikely that would be the reason for this very strong decline, almost $43 in today's session. Now, the prices of treasuries are rising, which has sent the 10-year and 30-year yields to the lowest level since April of 2009. That means that currently investors are favoring and retreating into treasuries. In addition, commodities as a whole struggle today, with silver down 5%. As we can see here, in a similar sharp down move as we had seen with gold, and oil was down nearly 4% as well. Looking back at the euro-dollar pair, we see that today's move pushed us above the 1.2460 level, which was our high back here on June 21st, 2 weeks ago. Today's 260 pip swing was the highest we had seen since early May, when the ECB had rolled out its 1 trillion stability package. The next level to the upside will focus on the May 20th high that we see here at the 1.2670 level. However, we'll see if the moves today were in fact an effect of the end of the maturity of the 12-month tender of the ECB. Just because US data is bad doesn't all of a sudden mean that European growth looks all that great, or that one good auction in Spain would cause such a sharp spike in favor of the euro. Taking a look at some of our other currencies, though we did see very broad dollar weakness today, we see that the pound-dollar pair rallied about 270 pips from low to high, moving above the resistance we had seen on our highs that we had seen for this week and to end last week. Zooming this pair out, we see that we continued to hold to this upward sloping channel as we had bounced up off this support trend line, connecting our lows from June 11th and June 22nd. In fundamental data, the UK did see its manufacturing sector continue to advance at a pretty steady clip, which may have boosted the pair as well. Though really, the main impetus here was a very weak US dollar. Taking a look at our third major pair, the US dollar Japanese yen, we see that we slid below our support from yesterday at around the 88.20 level and receded all the way down to just below the 87 level, where we did find some support and a bit of a counter rally. Switching to a 4-hour chart, we see that we blew past the support that we had set up back on May 7th around the 88 level, and that this is the lowest the pair has been since early December of 2009. Now, why is the US dollar falling out of favor even in an environment where global growth prospects are slowing? We had seen it to play during times of risk aversion, and concerns about global growth had tended to favor the US dollar as traders looked to find safety in the safe haven of US Treasuries. But with Treasury yields falling to lows not seen in a year or more, that investment is not paying off the same way it used to. Also, with the focus now on the actual slowdown coming from the US, the dollar is actually being sold on its weak fundamentals. Another question to consider in the US dollar Japanese yen pair is what will Japanese policymakers think about the yen's recent gains? A strong yen is bad for Japanese exports, and talk of intervention from the Bank of Japan would have a direct and an immediate impact on the currency. Let's take a look at a couple of the U.S. fundamentals that have increased the worries around the U.S. recovery. Let's start in the labor market. Yesterday we had seen a weak ADP private sector employment change report, but today we got weekly jobless claims that had jumped 13,000 to 472,000 for the week ending June 26th. As we can see from the chart to the right, the 4-week moving average of jobless claims is trending higher in the last month, and it's a troubling sign that the U.S. recovery is not able to add enough jobs in order to bring down the unemployment rate, which has dented consumer confidence. Today's figure will put extra pressure on tomorrow's non-farm payroll report, which may be worse than forecast coming into this week. Second up today was a measure of pending home sales, and similar to the sharp drop-off in new home sales following the expiration of the homebuyer tax credit, pending home sales also dropped 30% in May. That means the retrenchment in the housing sector is worse than anticipated and will have negative connotations for U.S. growth going forward. Thirdly, the ISM Manufacturing Index came in weaker than expected for June with a figure of 56.2 compared to 59.7 in May and forecasts of a smaller dip to 58.9. New orders, production, and employment sub-indexes all declined. While the 50 level separates expansion and contraction in the sector, so we are still actually experiencing growth, today's data just adds to the bearish sentiment around the U.S. recovery, and we could see that manufacturing is slowing compared to its recent levels from the chart to the right. So now with the U.S. economy looking very vulnerable heading into the second half of the year and job growth disappointing to say the least, the focus has turned to the U.S. dollar. Taking a look at the Australian dollar-US dollar pair, we see that it slid overnight, but then with the broad US dollar weakness, we saw it managed to pair its earlier losses. The decline was led by readings from China, which showed that its manufacturing activity was weaker as well. The HSBC manufacturing PMI was down to 50.3 from 52.7, and it's the third month in a row that the index has declined. As I mentioned before, the 50 level separates expansion from contraction, so it barely grew. Activity barely expanded during June. So we're heading into tomorrow's non-farm payroll number with a very weak dollar, and we'll see if it extends its losses to end the week. First off, though, in the European session, we will get the unemployment rate from Europe as well as producer prices and a measure of construction activity from the UK. Tomorrow, as I mentioned, we will get our non-farm payroll report as well as factory orders. We'll see also partly of today's weakness in the dollar was traders and investors pricing in a very poor non-farm payroll figure. So that will wrap up today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.